Welcome back. Microsoft had some major news come out today, so we're going to look at that and then do a deep dive into the financial statements and see if we think the stock is overvalued or maybe even undervalued. Alright, so let's look at that news. Alright, so if I just scroll down here, you can see first article, Microsoft shareholders vote for annual sexual harassment report. That's not it. Way less important than that is that Microsoft CEO sold half of his shares in the company. The CEO got rid of half of his shares. That should be sounding off huge alarms in your head if you're a shareholder, and that's what triggered me to do the video. So let's start with the share price history. So you can see I got a graph going all the way back to 1986 just to show this exponential. But I mean, we have had almost no major declines in the stock price. I mean, you can maybe count the 99-2000 bubble, but not really in comparison. So the question is it at a peak, right? Because growth like this can't go on forever, and all things that can't go on forever must end, right? I'm not going to be able to tell you when it's going to end, and if I was you, I'd be very suspicious of anybody who said they could. What we are going to do is look at the financial statements and try to get a valuation. So let's get started with the income statement. First up is total revenue. We always look at this. We like to see growth here, and we're seeing that growth. I mean, just look at this. $10 billion to $45 billion a quarter in 15 years. So I never use this valuation metric, and I don't think you should either. But in case you just wanted to get a quick rule of thumb estimate on a stock's worth, one way to do it is to look at price to sales. And usually price to sales at fair value is close to 1. Not always, and there's a ton of exceptions, but usually close to 1's an okay guess. So just look at this. 45 billion per quarter times 4 is only $180 billion, and their market cap is $2.5 trillion. What? That's insane. Let's look into this some more. Let's go to net margins. I'm not going to look at gross margin with a tech or service company because every tech or service company is going to classify their cost of sales in a different manner. So that's why I prefer net margin. Let's get this to percentage. Look at this. Wow. Recently, over 40% net margin. That would be a great gross margin in my opinion. So to have that as your net margin, that's awesome. And it's growing. Growing margin means that you have an increasing competitive advantage. And then on an absolute basis, it's already high. This is a huge check mark. All right, let's go to pre-tax income. Let's see if this trend continues. Back to dollars. Okay, pre-tax income. The story here is this recent just boom, right? From 2016 to now, it's just been amazing growth. If they continue that, I think it's going to be incredible. What am I going to do for the valuation? I'm going to take a very optimistic view because I'm trying to see if the stock is overvalued. So if I'm trying to see if a stock is a buy, I'm going to be very conservative and try to almost paint it in a negative light. If I'm trying to see if the stock could be a potential sell or potential short, I'm going to try to paint it in the most optimistic light I can. So I'm going to say $25 billion for our pre-tax income per quarter, which 25 times 4 is $100 billion for the year. So that's going to be what I put for my pre-tax income. All right, now let's do growth. You can see we're at 20 billion now. About 5-6 years ago, let's say 6 years ago, they were at, what is this, $8 billion a quarter. So to get my annualized growth rate, I do 20 divided by 8 raised to the 1/6. And I get 16.5%. I'm going to round up to 17%. All right, so let's go to earnings per share. Last part of the income statement. Always use diluted, and this one's easy. I'm going to take a trailing 12 months. Let me get these decimal points back in here. Okay, trailing 12 months would be the last 4 quarters, and the sum of the last 4 quarters is $8.94. So that's going to be my earnings per share for my valuation, $8.94. All right, on to the balance sheet. Real quick though, before I go to the balance sheet, this income statement was outstanding. Even if we get a overvaluation, I think based on the margin and the growth in the earnings per share and the pre-tax, there's almost no way I would short this stock. But shorting a stock is completely different than if you're already sitting on gains, whether or not you should sell, right? All right, let's go to the balance sheet. Total tangible assets is first. I'm going to break this down into total tangible assets per share. Real quick recap, what is total tangible assets? This is everything the company owns minus intangible assets. And intangible assets include goodwill and another category that's usually labeled intangible assets. But anyway, for this video, I took that number and I divided by the number of shares to get a total tangible assets per share. And I'm going to use this to get a return on tangible assets. So you can see here, our number is what? $37 dollars per share in total tangible assets. So to get a return on tangible assets, I'm going to do $8.94 divided by 37, and I get 24% return on assets. That's one of the best return on assets I've ever seen. That's incredible. No wonder they're so overvalued. Let's go to tangible equity per share. So this is the same thing, except before we divided by the number of shares, we also subtracted out all the liabilities. So this return on tangible equity is going to be that same $8.94 divided by whatever this number is. So what is that? Let's say 12.2. So $8.94 divided by 12.2, 73%. That's awesome too. But always look at return on equity in conjunction with price to book ratio. The two usually work opposite each other, right? If you have a lot of equity in a stock, you're going to have a low price to book because you got a ton of equity, but you might not be earning great returns on it. Likewise, you could have very little equity in a stock and you could be returning a huge percentage on that equity. And you might think, man, look at this great return on equity. But in reality, it's selling for 10 times book value. So it's kind of a wash, and that's going to be the case here, right? Look, take that 330, which is the actual share price, divided by that 12.2. So 330 divided by 12.2, 27 on the tangible price per book. Right, that is a super high tangible price per book value, but it's going to be that high whenever you're getting 24% on your assets and 73% on tangible equity. Still though, that's a really high price to book ratio, tangible price to book ratio. Anyway, nothing here that's a red flag to me at all. Let's go to the cash flow statement. First up, operating cash flow. So operating cash flow is how much money went into the company's checking account from normal operations. So what this does is, like on your income statement, you get to write off things like depreciation, or you get to book sales that haven't really been paid for yet, or you might have gotten paid for something that you booked in a previous quarter. So even though you received the cash this quarter, it didn't count because you had already booked it as a sale in a previous quarter. Operating cash flow is a way to track, literally, you can think about it as eyes on the checking account of the company. Positive means it's money coming in. Negative means it's money leaving the company's checking account, okay? So we'd like to see positive operating cash flow. I want to show you investing cash flow. This one's a little tricky whether or not you want to see positive or negative, because investing cash flow can include a couple things, right? First and foremost, investing is going to include all your capital expenditures, right? So any money that you put back into your assets or that you bought new assets with, that's considered an investment. So it's going to be money leaving the checking account of the company. That's going to be classified as a negative. Things that make the investing cash flow more positive would be like investments that the company made that is now paying them. I would say in general, you're going to see investing cash flow more negative than positive, but I really don't look at it. The only thing I pull from investing cash flow is the capital expenditures, because to me, that's most important, right? To get your free cash flow, which a lot of people say is the most important metric in all of common stocks, you take operating cash flow, the thing we just looked at, and subtract out capital expenditures. And lastly, to just wrap up our overview of the cash flow statement, financing cash flow. So financing cash flow includes things like dividends paid, which is going to be negative, right? Because even though it's getting paid to you, the shareholder, it's cash leaving the company, so it's negative. Stock buybacks will also be a negative number here, because even though it's using that money to buy back shares, it's leaving the company's checking account, so it's negative. Positives on the financing cash flow would be if the company went into debt, that would make the financing cash flow more positive. So in general, you do not like to see positive financing cash flow, because that would mean that the company is getting a bunch of money in through financing, and that could be either through debt or through share dilution. So both of those I'm not a fan of, so I always like to see this negative. Just wanted to point that out. Let's look at free cash flow. Let's get a number for our valuation. All right, same growth as the pre-tax. This is awesome. I'm going to pick $20 billion. So 20 billion times 4 is 80 billion, right? 20 billion times 4, $80 billion for the year. So I'm going to put that here, 80 billion. All right, and we're going to do a quick look at dividends and buybacks, both of which are great signs. And we looked at the financing cash flow and saw that it was negative, so I have a feeling that one or both of these is going to be pretty good as well. Yeah, look at this. Constantly increasing dividends. Love to see that. Let's look at share buybacks. If they're doing this too, shoot. Repurchase of capital stock. Yeah, they're spending an increased amount, $8 billion a quarter on repurchase of stock. And if we go back, what was their dividends? So $8 billion on repurchase and their dividends was, let's say $4 billion. So $12 billion a quarter of their free cash flow is in a way returning value to shareholders, but they're still growing the business. That's incredible. That is awesome. $12 billion a quarter, just put that in perspective. 48, that's over half the free cash flow, okay? Over half of their free cash flow is getting returned to shareholders, and they're still growing profit, growing revenue. I know I just said that, but that's just so impressive. It's unbelievable. Okay, let's go to valuation. All right, first one, rule of thumb method, the harshest critic, especially for growth companies, but I always like to do it. So $100 billion times 10, we get 1 trillion divided by the number of shares, and I get a target share price of $133 per share. All right, I expected that one to be low. I always expect this next one to be high. So this one is from Benjamin Graham's formula from security analysis. So 894 times 8.5 plus 2 times growth. So our growth rate was what, 17%? 17%? 380? Yeah. $380. All right. And our discounted cash flows is last. So we do our free cash flow number, $80 billion. Perpetual growth rate, always use a lower growth rate than you used previously, and make sure your growth rate's always lower than your discount rate. I'm going to show you why real quick. So I discounted 15%, right? And let's just say I had a perpetual growth rate of 18%. Well, what happens is that in your formula, you're going to grow faster than your discount, and you're going to get a super high net present value, and just don't do that. You're going to really skew your data like that. So I'm going to be very optimistic and do 10%, which is still lower, but it's definitely on the optimistic end. All right, and our net present value for the market cap is $1.818 trillion. So 1818 divided by the number of shares, 7.5. $242 per share, and that gives us an average price target of $250. So let's just look real quick. Where are we at as far as 252 divided by 330? About 3/4 of the current price. So I think the stock is definitely not at a discount. I mean, that's obvious, right? And I think it's a little overvalued, but at the same time, the intangibles and all the green checks that we got along the way could definitely push it into the fair value range. And I can tell you, there's no way I would ever short this stock unless it was probably 4 or 5 times overvalued, but shorting's a very dangerous game. But should you sell if you already own shares, lock in profits like their CEO did? In general, I don't think it's ever a bad idea to kind of act with the CEO. I can tell you one thing, I don't think I would ever buy a share in a company where the CEO just dumped half of his shares, but that's just me. You could have a different opinion. I'm not a financial advisor. I'm just here hoping to teach you some of these principles. If you did learn something, if you did enjoy the video, please like and subscribe, and I will see you next time.